So I'm just going to give you a bit of a look at what I think is an important question happening in the blockchain space regarding capital markets. Later on, we'll have a panel discussion. We've got a great panel that I'll be moderating on sort of broader questions about blockchain and its future and its relevance to things like trade. But I want to talk a little bit about what's happening right now in terms of the investment community, particularly in the US. There's a lot of interest in the idea that this once, unique, renegade, rebel world of cryptocurrencies and crypto assets could actually be something that Wall Street itself will start to invest into. And we have a big initiative coming from the Intercontinental Exchange, ICE, with a product called Backed. And people were talking about building custody services for institutional investors. And they're talking about investing in these things here. So this is just a collection of the number of the tokens that are out there associated with some of the bigger blockchains. And bankers are talking about it as a new asset class. So they're thinking, you've got commodities and you've got stocks and bonds, and now there's this new thing called crypto. And I'm just going to tell you a little bit that it may not be as cut and dry as that this is a sort of a very different form of investment than what the financial sector might be used to. And the reason is because underlying some of these ideas is this core idea of decentralization. And that decentralization, in some respect, of course, imagines the very end of the financial system that's investing into it. So there's a sort of a contradiction in this process. But one of the things that I think traditional investors like about it is that they see Bitcoin as an uncorrelated asset, and the same with all these other tokens. But if you look at the tokens themselves, they're all very closely, the blue in this particular data set from Cipher refers to obviously low correlation. But if you look at the red, high correlation, those numbers, that BTC, ETH, XRP, those are all tokens. So there's a lot of close correlation within all these tokens, which speaks to me to this commonality of what they're trying to do. And that thing is all about how do we change the underlying record-keeping system of the economy itself, right? So again, if it's not necessarily a bond or a commodity, it's an idea. We're buying an idea. And this idea is pretty intense because trusted record-keeping, that is the centralized ledger model, goes back 7,000 years. This is a Sumerian tablet that, in which, essentially at the very moment of civilization, when we first started to invent writing, it all came out of ledgers. But centralized ledgers have long had a problem. And I like to use two words, Lehman and Brothers, to explain to you why this is a problem. We've had these ledger keepers responsible for this fundamentally important process of record keeping for 7,000 years. And we have to trust them. And that trust can often break down. And what I think is a really key aspect of this in terms of how we define the potential value of the blockchain, and therefore why there is a community of people passionate about this kind of thing and why you're buying into that passion if you're investing in this space, is because the cost of trust that we incur when we rely on centralized ledger keepers is very, very high. It's an often a hidden cost. In this case, the cost of trust was essentially the financial crisis. The millions, the billions and trillions of dollars that were destroyed, and the millions of jobs that were lost, and the lives that were destroyed, right? So that's a cost of trust that society has borne when trusting these centralized ledger keepers to keep track of the numbers on our behalf is something that doesn't necessarily work very well. But it's not the only realm in which we see this cost of trust emerge. The cost of trust is evident across the developing world. So this is a slum in Nairobi. Somebody owns this house. That's their asset. They own that house. They can't monetize it, though. They can't get a mortgage on that. They can't sell it necessarily because there's no way for them to prove their ownership, their property right, when the registry of that ownership is untrusted. So many parts of the world, you can slip $100 behind the back of the counter and the guy will just cross out the name of the existing owner and write in your brother's name or whatever it is you want in there, right? This is a huge cost of trust. We're talking 2 billion people around the world that don't have bank accounts, something like the same sort of number who don't have access to official ID, all because the record-keeping function, the centralized ledger-keeping function, is something that we don't trust, right? But it's actually not necessarily as blatant as that either. This is New York, but it could be, you know, downtown Singapore. It could be anywhere in the world. Inside these towers, there are cubicles filled with accountants. And those accountants are doing more or less just one thing. The accounting function is there to reconcile one company's records with another company's records. Each of them a separately siloed, centralized ledger. That work, producing weekly book closings, quarterly book closings, annual audits, all of that work is a phenomenally large cost of trust, right? Because we have to trust these entities, because we don't necessarily trust each other, because we are separately defined institutions, we have a problem. It's not that there are bad people about to, you know, necessarily defraud us, but our entire political, economic, contractual model is defined around this notion of separate trust. So reconciliation, accounting, auditing, all of this stuff is enormously expensive. Now, what the blockchain represents, therefore, is a trust-minimized record-keeping system. There's still trust. I'm not here to tell you this is a trustless system, as lots of sort of utopians will describe. You still have to trust people putting data in. You still have to trust the devices that we use. But essentially now we have a distributed ledger. It's not a centralized ledger. It's a ledger that is shared and used in unison by everybody, and they're following a programmatic approach, an algorithm that allows them to arrive at consensus on an ongoing basis about the updates to that ledger. And then in unison, following this protocol, they are consistently increasing and updating the ledger. And what it essentially represents, and I always use the words quotes, immutable. Nothing is immutable. Something, you know, we can always override this system. But in the case of Bitcoin, which is the first implementation of this, essentially it has never been changed. You've never been able to go back and amend the ledger. You can only append the ledger. This is critical because throughout history, we've always had the capacity to go back and change a ledger. But you can't change it unless you get full consensus. This is a big change. This is a hugely important change. And it opens up a whole set of new concepts. One of them is the notion of a digital asset. Until Bitcoin came along, there was no such thing as a digital asset because anything could be replicated and copied. Anything digital. So we had your iTunes or your Kindle books were treated legally very differently from anything that was physical. You can sell a book, a physical book, but you can't resell a Kindle because the assumption in the legal community was it's digital, it can just be replicated. There's no scarcity, it can't be an asset, it can't be a form of property if it can be replicated. But Bitcoin can't be replicated. It's not like it's a thing, but it's a representation of value in a digital form. Non-replicable digital value. It's a very powerful idea because software can now be applied to the world of value. And money, essentially, can become programmable. Money as it is right now is agnostic. It's just an expression of value. And I hand you $1 and it's recognized that there's been a transfer of value from me to you. It's just a symbolic exchange. But that dollar doesn't actually do anything itself. Once money is synonymous with software, it can have powerful properties. And when you apply it with smart contracts, whereby it is able to actually essentially be the process of receipt and payment at the same time, so that it can turn a device on or a device off, or execute a transfer of property values. That aspect of it, where money is now embedded into our system in a decentralized way that nobody can control, is a very powerful idea. And all of this stuff is what's getting people excited about these concepts. I'm not saying that we've necessarily got an answer here, because those of you who probably heard the word ICO, the initial coin offering, will know that this massive amount of fundraising that went on, this is just a representation of the multiple ICOs over the last few years, and EOS being the big $4 billion number that came out recently. Massive amounts of money was raised all around these ideas that if you raise this money, you could create these decentralized communities and do away with the centralized ledger keepers and model entirely different economies around this thing. Well, ultimately, we had a bubble. The bubble burst. It's not sure that we're necessarily there yet. But at the same time, there's something pretty powerful about this idea that because we now have a digital asset, and that's essentially what each of these tokens is. So a token is a claim on some form of value that is built upon a decentralized architecture. And because it's run over a smart contract that nobody can change, I now have the capacity to interact directly with the issuer without having an underwriter in the middle of that. So the ICO market was a crazy bubble, but at the same time, I think it's worth remembering that something profoundly important happened here, whereby somebody with an idea could essentially find a market for that idea directly, a democratizing finance. But the ICO market was kind of crazy. People were just writing white papers, getting a lot of money, and not necessarily delivering any products. And the SEC in the US and other regulators around the world, Singapore as well, took some interest in this, started to get concerned that essentially unregulated, unregistered securities were being issued and that the market was going to be exploited in this way. So the Lambo moment, a lot of people talking about Lambos that they could make money quickly on, is kind of being thrown away. So we're saying goodbye ICOs, and instead we're saying hello STOs. An STO is a security token offering. This is the new buzzword on Wall Street. And the idea is that you don't actually sell these tokens to all comers in a broad, decentralized structure. You go through a normal regulated model, and you sell the token to accredited investors or under some formally regulated issuance. We've kind of gone back from the extreme to a more regulated model. Now, this is interesting. But the question is, are all we're doing here is just necessarily improving back office efficiency? So all of these various things, automating a complex securitization model, real-time share registry updates, index data updates, disintermediated underwriting, these are all benefits that could come to the financial sector by having a tokenized, smart contract-based security issuance project. Get away from all of this complexity and go direct to the investor with a lot of this inefficiency removed. And that's pretty interesting. There's a lot of money to be made out of that and to be saved out of that. But we're really just sort of bolting onto the old system at just a slightly more efficient model. Or is it a new social paradigm? I think this is the tension that's going to emerge out of this process. Again, if you're going to be buying those assets we talked about here, you're buying into ideas that are all about something completely different. A fully decentralized, distributed peer-to-peer system without individual institutions like banks sitting in the middle of that exchange. That we have entirely new models for credit, entirely new models for asset issuance, without these institutions in the middle. So the question is, are we doing something that's just about making finance more efficient, or are we actually reimagining the entire paradigm of how our economy works and how value is exchanged? So Wall Street says there's a bunch of things that need to happen to make this system work. They want audits, risk assessments, founder accountability, sophisticated low latency exchanges. We need to solve this big problem of custody, which is really complicated for institutions when it comes to how they deal with these tokens. And security laws need to be enforced. And all of that, I think, is absolutely true if you look at what the ICO market was like and how many people got hurt through the sort of rather duplicitous way in which some of this money was raised. But the perspective from the developer community, those who are really passionate about this new decentralized future, is that the real problems aren't really about how we regulate and how we bolt onto this new system all these old ways of doing things, but rather we resolve the integral problems of the technology so that they become fully accessible on a wide adoption basis. So there's this thing called layer 2 scaling so that we can start to put much more transaction throughput through these systems. There needs to be blockchain-based accountability. So rather than relying on regulators, the blockchain itself can be our source of accountability. Exchanges should be decentralized. Nobody in charge of the exchange necessarily. There is a method by which I can directly exchange value with each other. Custody solutions should be in the hands of the individual through special multi-sig hardware wallets, and utility tokens should be given special exemptions, which is something that Singapore is exploring, I think, in some way and quite interestingly. Anyway, these are all the future, according to these guys. Now, all I would say is I'm not going to take a position on all of that. I do think there's a huge need for a regulatory framework in which this happens. I think that we had, as I said, a crazy bubble that needed some regulation. But we don't want to throw the baby out with the bathwater. This decentralized future is a very exciting concept. I talked before about the cost of trust. Reducing that cost of trust across our economy can be a profoundly powerful thing. And if we end up over-regulating and just trying to cram everything into the same square, this square peg into a round hole that reflects our existing architecture, our existing financial system, our existing regulatory system, we may be losing this powerful opportunity to take something like a utility token, which is something very much connected to these decentralized architectures, these empowering aspects of our communities, and losing that opportunity. Because it's about, essentially bringing the 2.5 billion unbanked of the world into this system. It's about removing these barriers, and that's what gets people passionate. So there's a lot of tension still to come. All right, so I'll leave it at that, and I'll invite the panel out now. Is that what we're bringing out the team?
Yes, thank you very much, Michael. We're going to set up the stage very quickly right now for the panel discussion. And of course, today, ladies and gentlemen, our panelists we have joining Michael on stage is Brian Behlendorf, Executive Director of Hyperledger. A big round of applause, please. We also have joining them Jim Sullivan, Deputy Assistant Secretary for Services, U.S. Department of Commerce of International Trade Administration. And of course, last but not least, we have Virgil Griffith, Ethereum Foundation. Need one more chair up.
Okay.
Oops. Oh, let me help you.
Oh, watch it. There we go.
Blockchain right here.
Yeah, right.
Okay,
That's right.
fantastic.
The fourth block is now being.
All right, and now, Michael, the stage is yours.
Low latency blockchain too, yes. Very, very impressive. Okay, guys, thanks very much for that. So you heard me talk a little bit about the state of the capital markets. I thought that might be an interesting one, at least for you to start out with, given that we're at a fintech conference. But there's so many other things to talk about in the blockchain world, and we're going to explore some of that now. But why don't, for the sake of getting people familiar with who they are listening to, each of you guys give us just a quick introduction about what you're all about. So Brian, please tell us about you and Hyperledger.
Sure. So Brian Behlendorf, Executive Director of Hyperledger, which is an open source collaboration project hosted at the Linux Foundation, where we're building a lot of individual software components to allow networks of organizations to go off and build their own distributed ledgers, their own blockchains, if we want to use an expansive term of the use of the word blockchain. But it's in production use today in about 50 different types of networks out there, covering trade finance and supply chain, healthcare, a number of different uses for it, all built under an open source license, all built in a very public, transparent way, and trying to really get this technology out there in as many hands as possible.
Thanks. Jim. Yeah, it might be already on. Yep.
Am I on? Oh, thank you. So Jim Sullivan, I am the Deputy Assistant Secretary for Services in the U.S. Department of Commerce at the International Trade Administration. Just very quickly, very briefly, I'll explain. Most folks may be aware that at a high level, the Department of Commerce basically exists to promote economic growth. At the International Trade Administration, what we do really is focus on creating the conditions for U.S. firms and industries to innovate and to compete globally. And we do that by enforcing our trade agreements. We do that by promoting trade and investment transactions around the world. And in my shop, what we focus on, we're really the policy shop at the International Trade Administration. And we really help to develop strategies and initiatives to address trade barriers around the world, but also to foster and accelerate innovation, obviously, in things like blockchain. And we're hearing from an awful lot of stakeholders. There's a lot of hype, but we do think there are some really key areas where blockchain has real potential, particularly in the trade space. I look forward to discussing those. So thanks.
Great. Thanks, Tim. Virgil.
Hi, my name's Virgil. So I did my PhD in neuroscience, actually. And I knew Vitalik back from forever ago, and he eventually
Vitalik
asked
Buterin, the founder of Ethereum. Yep.
Oh, yeah, Vitalik was the founder of Ethereum, my 23-year-old boss. Yeah. So he eventually asked me to come join him, and I eventually said yes. And I lead special projects, which is kind of a variety of things. Probably the most exciting thing we did, we used to give a grant to Ethereum Classic to do more broad-scale collaboration. We also recently, we're soon getting Ether declared Sharia compliant. And so, and we've now, I'm just kind of looking at kind of, broader cooperation with, people like you all.
Great, okay. So why don't we just kick it off with you, Brian, if you don't mind. Give us a kind of a 30,000-foot view in a way, because the Hyperledger community is really sort of spanning a whole lot of different initiatives right now. How would you describe the state of blockchain development as it is right now, and where the kind of where it's going essentially? What's the big opportunity?
Right. Well, this year has really been the year where a lot of projects that had been in proof of concept or in pilot actually made their way to production deployment. So there's a project announced just today, actually, DLT Ledger is a startup based here in Singapore, working with DBS Bank and about 140 different trading organizations supporting 4,500 farmers in a supply chain around Australian agricultural products. Trade finance. They've already processed $750 million worth of letters of credit on this system, and that's in 2 months of production use.
Tell us a little bit about what the letter, because this is going to be, I think, a theme that we'll get to with Jim as well. But I mean, how does the blockchain help for something like a letter of credit?
So these are necessarily multi-party processes that involve a significant amount of trust, a significant amount of cross-border coordination, involving regulatory authorities, involving a deep need to understand who are you doing business with and what is the history that they bring. Are they reputable parties who are good for the promises that they make? And then ultimately settlement as well. And so doing those things in a centralized database system, in a traditional kind of market maker, carries risks with it, and the inevitable political questions of, well, who gets to run that database? Because essentially, they get to play God. In a distributed ledger, in a system where all parties not only can write to that system, but verify that the transactions written by other parties were written in the right way, where you can implement things like prevention of double spend and other things that we know from the cryptocurrency world as being very valuable. You can cut a lot of cost. You can open up that to a much broader audience of participants, and you can have the big banks get involved. You can have large sources of capital, but you can also open that up to small players as well.
So, I mean, one of the things I think that's interesting is that, it's easy for me when I give that presentation I gave before to point out that something like a property registry in Nairobi is something that you can't trust and you can resolve. But the point here is that it doesn't matter how sophisticated this one. I'm an Aussie. I would like to think that the Australian, system is fairly well reliable and trusted, but because of that centralization of control, it creates all these barriers and so forth. So on that note, Jim, since you're looking at a realm, in fact, that I think is a critical one where trust will break down, that is the cross-jurisdictional and cross-border world, what do you see as the big opportunities for blockchain to resolve trade, whether it's finance or actually supply chain management?
So I think really, as I said a moment ago, we meet with dozens upon dozens of stakeholders. There's obviously a lot of interest in blockchain for a variety of reasons. A lot of industries are developing applications right now, but as I noted, there is an awful lot of hype. And in many cases, they seem to be solving a situation that could easily be addressed by existing technologies, perhaps optimized a bit better. The technology is also not necessarily there. So there are technical burdens or hurdles to be overcome. Obviously, there are regulatory hurdles that lots of different countries are trying to grapple with and address right now. But really, when it boils down, and again, in my role in services, which constitutes 75% of the economy in the United States, 82% of private sector employment, there really are two core areas in the trade space where we see blockchain being truly potentially valuable, and that is, as you just touched on, trade finance. I think we have something approaching $1.6 trillion gap in trade finance, which disproportionately affects SMEs, small and medium-sized enterprises. They just cannot get access to financing. Their foreign buyers can't get access. The markets that many of these companies are trying to get into are very risky. The margins are often very low. So again, for all the reasons you just cited, I think trade finance is an optimal space, and there's an advisory committee for Secretary Ross, Secretary of Commerce in the United States, that is working to evaluate different standards around the world to assess, how feasible it is to employ blockchain in trade finance. A second area, though, is supply chain for a lot of the same reasons. These are very paper-intensive, not terribly efficient. When products move through supply chains or intermediate products or final products, they're moving from the container ship to the port to the truck to the rail, et cetera. There are lots of different points of embarkation, and there's lots of paper that trades hands, and it's terribly inefficient. Bills of lading, letters of credit. If you could put smart contracts in place, if you could attach tags to a lot of the containers and track them, I think there's great potential, and we're already seeing a lot of experimentation in the space. So those are sort of the two key areas that we're seeing that I think are probably the most realistic and the lowest hanging fruit right now.
Okay. Virgil, when we were chatting a little bit earlier in the green room, you were suggesting that, in fact, the future might be something far more dramatic than just trade finance, which would imply that we need banks to actually come in and say, you actually think that all this stuff will actually move to remove banks from the structures, right? It's the
I suppose. At least in the world that I come from, there's a nice slogan people like to use. It's called "Unbank the Banked." Yeah, it's not bank the unbanked. It's unbank the banked. It's the other way, and and they kind of this idea that that a lot of the centralized infrastructure that it's basically just a kind of a tax. And would it be nice if we didn't have that tax? And so they're often trying to come up with more efficient processes that go around the current infrastructure. And how successful they'll be, I guess, remains a bit to be determined. But this is at least an ethos that you hear voiced.
Okay, so there's Jim used the word hype a little earlier, and whether it is the idea that we might move to a bankless world or something sort of like that, this concern about hype is it gets out a lot, right? It's something that is often used in a way that I think diminishes the impression of the crypto community because of the Lambo mindset and so forth. Brian, what's your take on hype? I mean, is it how do you deal with, because you do see these broad, expansive solutions for so many things.
Well, I have to say I'm a little disappointed because you told us that we'd have blockchain Long Island iced tea in front of us while we were talking.
Which is, you might as well tell us what that was all about. That was the magic solution to driving up your share price by just changing your name.
A failing IC company decided to put the word blockchain into its business, saw its stock spike by 300%, something like that, then come crashing down when people realized it had nothing to do with it.
Tea tastes horrible, it still tastes horrible regardless of whether you have a blockchain involved.
No, but and no doubt, that magic word blockchain, is kind of like the words internet or the word open source software. It has stood for one thing that might be different than somewhat its originators perhaps have said, but I think these waves of technologies do come in and crash over the rest of the world like waves on a beach, right? And what happens at the peak of that wave is a lot of silly things, right? A lot of overinvestment, actually, in plumbing and in infrastructure, right? A lot of cab drivers suggesting stock tips to you, right? Those sorts of things. But at the end of the day, there's downsides. There's a lot of investors, average retail investors, to get hurt by that, and that introduces new regulations and that sort of thing as much as it reinvents that, so that's a danger. But at the same time, it creates a lot of capital to go and try a lot of ideas, some of them very crazy, and frankly a lot of really innovative stuff comes from a lot of funding, a lot of really crazy things out there. So let's give that its due credit. Let's also realize we're all sitting here today talking about blockchain technology thanks to somebody named Satoshi Nakamoto, whoever she was, to actually who actually helped demonstrate that this concept that's been around in the technology space long even before 2008 around building distributed ledgers, when paired with some novel innovations like Nakamoto consensus, has allowed us to show us at scale what's possible, right? And what's possible in a kind of a reinventory kind of way. And that'll get understood very differently by other parties and worked into existing infrastructures, much as the internet was. I mean, in the early 90s, I think a lot of people thought we would disconnect the major telcos, right, and all be doing mesh networking point-to-point using TCP/IP packets, right, or other much more radical kind of notions, and instead it gets mainstreamed. Now, some companies did not survive that transition. Others came out of it in a completely unexpected different way, right? Google, Amazon, those sorts of things. And so I think likewise, this is a technology that will make for gigantic new companies we've not yet heard of in a 20-year cycle. And I mean, some companies that have been around for 100 years will still be around and have reinvented themselves through this. So I think the hype serves a useful role. It's regrettable where it's led to investment losses, though.
Okay. The way you describe these companies emerging out of this, does speak very much to as well, though, the perspective that Hyperledger has embraced of the enterprise blockchain. The idea that this is a software, a technology that services, or can service existing enterprises and their ecosystems and the like. Virgil, just to bring you in on this, because you might see things a little differently. The Ethereum perspective is, the permissionless blockchain, the role of a token tends to be less thought of as an enterprise solution and one that sort of gets seeded out into a fully decentralized community that kind of pre-exists that. What's your take on this issue about, what is the decentralized ideal that Ethereum would foresee, and does it differ from what Hyperledger is doing?
The decentralized thing, I mean, it's not really that complicated. I mean, I don't know. I mean, the world has a lot of powers. They don't always agree. I mean, if the United States said, we're going to create a brand new internet that we're going to control, I mean, China probably wouldn't be too cool with that. I mean, I feel like Singapore understands this very well. They understand that they have to play this kind of middle ground. They have to be kind of a neutral ground where multiple strong powers can be kind of equally uncomfortable. And so we think of, Ethereum as a little bit like that.
Okay. But you would suggest that, and you were saying this before, that a blockchain should be something that is it needs a token, for example, right? Which is
yeah.
Whereas I think the Hyperledger model is to suggest that you sure. Different consensus mechanism to.
You're picking a fight.
I'm trying to make a fight here.
Okay. No, we can fight. Sure. No. So okay. So I'll give you something. Okay. So in Singapore, I've routinely come into bankers. They say, I'm edgy, so I'm into blockchain, but I'm not crazy because tokens are crazy. And I say, no. You actually have to have the token because the reason it's actually a necessary condition of the blockchain to work. Because the way it works is people validate the ledger and they add new blocks to the ledger. And the reason they do that is because whenever they do it, they get a little integer incremented on their account. And that shows you've done something useful. And that integer is transferable. Oh, well, there you go. I mean, that's just called a cryptocurrency. And unless you have that, there's no incentive to maintain this thing. So yeah, no, like having a token is a necessary condition for an open ledger.
Right. And now I am going to get you to respond, Brian, because there is a different perspective there.
And so part of this is about answering the question: are we all going to conduct all transactions on one global ledger, or will there actually be a kind of a heterogeneous world of a bunch of different ledgers with different motivations and different populations and different rationales for existence? And I certainly think there will be one or a small set of public ledgers that will ultimately kind of be a backstop. Kind of in some way either a final settlement ledger or a way to look up identities or some sort of thing that might be similar to the role that, say, public newspapers play. But it's clear that the vast majority of transactions in the world between peers, between parties that are multiple participants in a business process of some sort, perhaps even to consumers, will happen over ledgers that look a little bit more like consortial ledgers. And for there, the kind of typical rationale for running a node on such a network will be, well, you are one of n number of other parties wanting to do business on this network, and so therefore you have an intrinsic motivator to be a part of that network, to stand a node, and frankly, it doesn't take a lot of compute power to be able to handle a couple thousand transactions per second on such a network, even with today's technologies, right? So being able to expand that to hundreds of nodes, thousands of nodes, and then having other networks out there, there's still some hard questions out there. How do we discover these? How do you make the cost of joining those networks as low as possible so that for even a small business, joining that is a matter of review a legal contract, sign it, and you're on? How do we make doing transactions across these ledgers cheap? All of that is still important work that's in progress today. And that's a lot of what we're trying to figure out at Hyperledger is how to do all of that.
Okay.
Or you could just have a token.
Well,
More than that.
so, but one thing that came up there I think was interesting is that, it's a vision of multiple ledgers interoperating with each other in many respects. And so this itself is a challenge. How do we create this interoperability? And I'd like you to weigh in, Jim, because you talked a little earlier about this problem of, from the global trade perspective of data localization. And so, if we're going to encourage a sort of efficient global trading system, figuring out how we can interoperate across these different siloed data structures is critical. What are you looking at in that regard? What do you see as some of the challenges and opportunities?
So I think it was touched on this morning in one of the opening addresses. We are unfortunately seeing a real rise or proliferation of these protectionist measures in the digital space, whether it's the rationale is privacy, whether it's cybersecurity, whether it's law enforcement, or whether it's just sort of naked protectionism. I think most of them, really, the rationales are not justified. I think the cloud is actually, in many instances, far more secure, if not most instances. Privacy, again, should be very narrowly tailored, and I think in many instances, the regulations we're seeing are rather broad in a lot of instances. So what we're working very hard to do is, we're engaging bilaterally with countries, but I think, we are trying to promote interoperable frameworks on data flows, cross-border data flows, like the APEC cross-border privacy rules system, in which, basically this framework recognizes, look, we don't all have to have the exact same regulatory approach or domestic regime to privacy, but why don't we all agree to sort of a fundamental baseline of standards and protections, and that way we can have safe, secure data flows in regions. We at the Commerce Department, we've been approached a lot by countries outside of APEC that are interested in CBPR. I think interoperability respects, on the one hand, that there are different cultural differences, there are different sort of historical approaches, whether it's from a legal point of view or other, that we don't all have to have the identical approach as long as they're interoperable and they can be made to work together. And I think you're going to have that for blockchain to really work. I mean, if the data stops at the border, the digital economy just doesn't work.
Right. So it is actually, interesting to see it from this regulatory, cross-border, government protectionist perspective, but in some respects you could say similar issues can arise across blockchains that can't interoperate with each other. I mean, Ethereum's been thinking hard about standards and trying to develop that. What's your take on how we address this interoperability of data and of assets question, Virgil?
Well, so I think one of the good things that Ethereum has done is it has put a lot of good standards. So even if the value of Ether, even if it went to zero, I mean, we'd all be very sad. But even if it did, I mean, we've done like a lot of really good work on token interfaces, identity, and stuff like that. And and you see some of these you see similar standards being used on other chains. And I mean, please use them. like they're free. Yeah.
In fact, I'll add to that. We have one of the 10 technology code bases at Hyperledger is something called Hyperledger Burrow, which is an implementation of the Ethereum virtual machine, which is the engine for running Ethereum smart contracts. And that runs standalone, but it also runs on top of Sawtooth and now Fabric. And what that gave us for free, thanks to a lot of the hard work going on in the Ethereum community, is the ability to run in a consortium environment ERC20 tokens.
Anytime.
Right? So those are tradable within. Adopted some of the identity standards as well there, and try to also answer this question about interoperability at a couple of different layers, like the language, the programming language used in that community now can be the same whether you're talking about a banking network or the public network, and naming standards for various things, etc. So really exciting stuff.
Okay, I'm looking to see if we've got any questions here. I'm not sure that this is loading, so I might need to call a technician up here to get this to work, but it's just giving me the ever circling orange dots right now, which I don't think is going to be very helpful. So look, I mean, Jim, maybe you could, you said this is a concern, and you talk about it from the policy perspective. And clearly, you know, I would argue that the last 2 years has seen a significant deterioration in the state of free trade around the world. What do you see this tech helping get us back to a more harmonious and sort of free trading environment? I mean, how do we square these issues right now? This technology solution, interoperability problems, and the reality of a global trade environment that is not quite as happy as it was a few years ago.
Good luck, bro.
So
I said good luck.
I thought you said give up. I think, you know, just at a high level, there have been obviously some significant changes on some approaches on trade. And I think, you know, from the United States perspective, a lot of what is driving, and I'm going to speak very high level, some of the changes of late is a recognition that, you know, there was a system in place and a number of actors came to that system and joined it, but have not necessarily been playing by the rules. And so there are some actions being taken to try to address the fact that we don't really always have a level playing field, and that perhaps you know, more could be done by some to sort of play by the rules and put some disciplines in place to make sure, again, that, you know, I'll speak for the U.S., that U.S. businesses have access, market access, that actors are abiding by their obligations and their trade agreements and, you know, different international frameworks and rules and international fora. So at a high level, I think I'll just leave it at that in terms of the dynamic. But in terms of what we can do, given that dynamic, I think there's a lot of agreement between the United States and many of its partners on just how essential the free flow of data is. I think, you know, we saw in the new USMCA, the new digital chapter, I thought was extremely encouraging, and it's probably the most advanced out there in terms of, you know, trade language on the digital economy and promoting the free flow of data. I already talked about Apex CBPR and the fact that we've seen a lot of growth in the last 12 to 18 months in terms of economy participation. I think we have to do more to sort of get the word out about what it is. I think, you know, GDPR went into effect in May. I think a lot of companies rushed and put a lot of energy into complying with that, and are maybe leery of saying, oh, yet another framework. But again, given the fact that, you know, where we are right now in terms of the connectivity growth, the potential here of the digital economy, and the fact that different countries do take different approaches to these issues, that is a great approach in terms of interoperability. And again, there's been a lot of interest in that outside of APEC. But I just want to stress there, I mean, the data flows now, I think there's about 4 billion people online right now. That's only continuing to grow at a ridiculously fast rate. We have something like 2.5 quintillion bytes of data being generated every day, which is a figure, I think, followed by 18 zeros, if I remember correctly. That's only going to continue to grow as we have, you know, increasing growth with connected devices. Data underpins everything, every sector of the economy, you know. So I think that, from my perspective, is probably the most critical issue. And I think there's a lot of unanimity among a lot of countries, the United States and its partners, but others as well. And I think we all need to work to address some of this localization in particular that we're seeing that really is not justified in most instances.
Okay, Brian, I think maybe you could weigh in here a little bit, because one of the things that comes up when we talk about these issues is this, you know, reality that we live in a world of laws. And if we think about things like supply chains and smart contract-based supply chains, blockchain-based supply chains, you're still going to have, every time we cross from one border to another, different jurisdictions. What are your thoughts on how we might bring governments together to give the right kind of framework for regulations, for standards and the like, such that we can interface this, I mean, code is not law, but, you know, this concept of code being able to interface with law that is the external law?
Right. So two different levels of this, and everyone's heard the diamond ledger example, but what you might not realize is the reason why that's so interesting. And this is now the diamond industry shifting to the adoption of the use of a distributed ledger to track where diamonds come from on their way to the retail network, so that when you buy a diamond of any appreciable size, you can be sure that it actually came out of the ground, but it also came out of a mine where that didn't deploy slave labor. It was a diamond that wasn't used to purchase weapons. All the kinds of things that actually we might agree represent a reasonable set of regulations in an industry with such a poor track record, right, and of such a kind of a murky kind of like backstory, right? And this was actually implementing an agreement called the Kimberley process, which came out of a bunch of negotiations happening about 15 years ago that was arrived at by 88 nations and all the major companies in the diamond industry agreeing, here's the traceability mechanism we'll use. Well, before the arrival of a distributed ledger, they had centralized that all of that data in the form of data being sent to an organization in Antwerp that held it on its servers. No surprise, because it's a giant honeypot, they got hacked, and that data was actually not only pilfered out, which wasn't a big deal, it wasn't intended to be highly confidential, but the hacker got in and changed the color and quality of every stone in that database, thereby rendering completely moot the value of that database as a reference point at all. And in a way that destroyed backups, it was kind of really bad. So that industry is moving to a DLT, partly for data integrity, partly for immutability, but along the way, to add greater integrity to the claims that these diamonds came where they actually came from. Now, that doesn't mean what gets written to a blockchain is truth simply by virtue of the fact that it's written there. It has to be backed with the history of the parties that are involved in that. Have they been credible providers? Is there traceability? You can look at the diamond, see a barcode, it actually matches the amount, what's written to the ledger. But it has, in the prevention of double spend, right, the key to being able to say, diamonds can't just appear out of nowhere. You can't have one diamond that branches into two and becomes two different entries in the ledger, that sort of thing. And that's the key to adding this greater integrity. And by the way, it has to be complemented by inspectors, people at the borders kind of looking at this stuff, people in the field able to blow the whistle when they see a big truck coming from the Congo and dropping a load of raw diamond ore, at the right place. So all of this is about enhancing the integrity of these kind of existing systems, which hopefully brings down the cost of these regulations when they are well-intentioned, if they're not just obstructionist or just about implementing tariffs or that sort of thing, but actually about bringing credible business processes and the kind of integrity we want to see any of the, say, the Sustainable Development Goals implemented or any of these kind of things that we want to see changed about how the world works brought into these systems. We'll need credible accounting systems to be able to know that we're dealing like for like. The second layer of this, though, is really in the data management question. The world, I think, is moving on from kind of a mainframe or Facebook, if you will, style of treating digital identity as an interesting set of things about you stored on a server somewhere into which you have a name and password and nothing else, to a world where data is more sovereign to you, where data is more local to you. It's held in a wallet of some sort, and that wallet is not just payment instruments like a credit card, but things like your diploma, your driver's license, your healthcare records, and if you happen to work across many different countries, your permits to work across those, your ability to move from one country to another, all of that embodied in a digital record of sorts. If that is a bureaucratic process where there's layers of human-driven kind of effort, and a lot of that introduces a lot of room for corruption, a lot of room for bad actors to be able to get away with things. And the use of distributed ledgers there, particularly to have kind of a decentralized digital identity infrastructure, provides a lot of hope that we can have a regulatory regime that does the right thing, I think, in terms of trying to give individuals a sense of agency back over their personal data without it becoming an onerous, difficult to achieve, difficult to implement system as kind of this first wave of responses that GDPR has been. So I'm hopeful. I think there's a pathway out of this that allows us to have our cake and eat it too. And a lot of that is due to this technology wave that we're talking about.
Virgil, you seem to be...
I mean that sounds right. That sounds good.
So supply chains are obviously, and management trade itself. Singapore is this entrepot. It has built itself really on being this center in which the world's trade can pass through. So, what do you foresee, Virgil? I mean, what a kind of a world of trade would look like? Do we get to a world where every single thing has got a barcode RFID chip and it's just automatically transacted without any intermediaries? What does the future of trade look like for you?
I mean, I guess ideally it would look something like that. I mean, I don't know. I mean, there's something that I always thought was, something since why it hasn't been done already. I thought to me every shipping container in the world should have some barcode on it, and any time one of the shipping containers touches port, the key of that port publishes, oh, this barcode touched our port at this date, and this is what was in it. And then if you ever find some place anywhere that has contraband in it, you're like, oh, what are all the previous places where it touched ground? And I mean, I guess in theory, pirates could still do offloading like in the middle of the ocean. But I mean, that kind of, they've earned it. They've earned it in that case. Yeah, and I guess, and if places don't want to play by the system, I mean, give them like a 1% tariff, so something like that, and they'll all join, and you're like, okay, great. And then we just have suddenly we just have a automatic tracking of all packages, and like. Wouldn't that be great? And smuggling gets like vastly harder. It's not even that much hard. I mean, like you could do that in a year.
Okay, well, we need a commonality of customs law, or at least approaches to customs, right? There needs to be to this idea of standardization. If we're going to be able to sort of implement it in a seamless way. In the reality of nation states that we live in, there's still going to be these borders in which laws are going to exist about what can and can't come in. Do you have any thoughts on this, Jim, as to what how do we harmonize, or at least make more incompatible, I would say, the sort of the structure of customs laws and the like with these sorts of technological solutions?
Yeah, and actually you've hit on, again, not to keep talking about me, but obviously the area I work in, services, is probably where we're seeing the most innovation in blockchain and a lot of the digital space. But services sort of an end product in and of itself, but also touches and supports everything else. And you talk about customs, e-commerce has just revolutionized so much of how we buy and sell products these days, and it's been phenomenal, particularly for entrepreneurs and for small businesses who can now, in a way they never could before, create a product or a service and sell it to people on the other side of the globe and access these markets really in a way that is just unprecedented. And yet we run headlong into these problems that you just talked about, where customs issues, where you can get it there overnight, but then it will sit in customs for weeks, maybe months in some cases. From our point of view, the best way to address these issues are really in a place like the OECD, International Fora, that's really very evidence-based, as opposed to sort of one country or group of countries sort of enacting their approach without really giving others the chance to sort of discuss it and come to a consensus. I don't think that's productive to have sort of competing regimes on these issues. If you can come to the table, and again, we really want to emphasize evidence-based. So many of these conversations today have become so polemical, for lack of a better word, and politicized. I think if we can use data, as you can tell, I'm very big on data and digital, and come up with an approach and a consensus on how to address these issues, that's the ideal. We don't want to have more fragmentation and more diversity of approaches on these issues, because it's expensive for businesses, sorry to cut you off, and it's just the same points Brian just made. It just doesn't help anybody.
Well, I think you'll find consensus amongst us that consensus is necessary. It's very, very much a view that's shared in this community. Anyway, so thanks very much for that, Jim. Thanks, Virgil. Thanks, Brian. Thank you, everybody. I apologize for not being able to take your questions. The Slido is not quite working, but please give a round of applause to our panel and enjoy the rest of your conference.